The 5 biggest mistakes that new property investors make when starting out and learning how to grow a successful property business. Hi, my name is Richard Norris, and for those of you who don't know me, I'm the founder of a company called Property Consulting.io. We help everyday people start and grow successful property portfolios, and we also help existing privately owned property rental businesses and property landlords to scale past 8 figures. So without further ado, let's jump in. So the very first mistake that I see that most property investors make is they buy properties in the wrong tax structure. Now, they either buy properties in their personal name, in an LLP, or even an off-the-shelf limited company. Now, the biggest mistake I see people make is really buying properties in their personal name or buying them in an off-the-shelf limited company. Now, let me explain and break down why this is a really bad financial move and why at scale this financial kind of mistake costs you millions of pounds as you scale out the property business. Firstly, if you buy properties in your personal name, you're subject to Section 24 income tax as a higher rate taxpayer. This is because of the punitive tax legislation that was brought in by George Osborne in 2016. And as a higher rate taxpayer, you're unable to offset any of your mortgage interest relief. You get taxed 40% on the gross rental income, and at the end you get a 20% relief on the annual mortgage interest payments. Now, this is a huge problem for a lot of investors that we work with. We have a program called Quantum Property, and a lot of our clients, even our high net worth clients, and I would classify high net worth as anyone who's worth between £1 million and £10 million net. They come in and they've got properties in their personal name or their own jointly between husband and wife, etc. And it's all a bit of a mess. They've got a Section 24 income tax problem. They've got a capital gains tax problem at 24% on disposal of assets. They've got maybe even a latent gains tax problem where they basically have refinanced the properties so their outstanding mortgage balances are above the base cost of the properties. And the biggest problem that they face is they got a 40% inheritance tax bill. Now, our largest client, who had 144 properties, had an inheritance tax bill of £4 million upwards. So this isn't something to be overlooked. People, if you're buying properties in your personal name, it's a big problem. And I'd strongly advise, as a thesis, as a strong conviction, to invest in a limited company. Do not invest in your personal name, okay? So that's the biggest mistake that I see people make when starting out. They set up the tax foundations all wrong. But secondly, they think that, okay, well, to solve this problem, if I don't buy properties in my personal name, then I'll buy them in an off-the-shelf limited company. What do I mean by an off-the-shelf limited company? Just basically a limited company to set up. Typically costs you around £250 to £300 for an accountant to set it up for you, and they think that that solves the problem. Okay, but it doesn't. And here's why. Yes, you can offset your mortgage interest against your rental income, so you do get that back as a tax allowable business expense, and you can benefit from the use of something we call director's loans account, so it is more tax efficient than buying in your personal name. But the biggest problem that you face when you buy properties in a normal off-the-shelf traditional limited company without any kind of financial perspicacity or any kind of future thinking is you end up creating a 40% inheritance tax bill as you scale the property portfolio over time. Now, let me just explain how big this problem can become and how it can compound over time. Most people have short-term thinking, and they just think about today. I'm going to build a property portfolio and I'm going to buy 5, 10 properties in the next 5 years, right? But the problem with that is they just think about the next 5 to 10 years. They don't think about the 20, 30, 40, 50 years that they're building the property portfolio for. Because if we're truly being frank with each other, if you're successful when building a property portfolio, which you will be if you follow our content, the goal really is the infinite game of business, to own those properties and probably to pass them down to your kids or grandchildren or beneficiaries in the future, so that these properties that you buy today are going to be in existence for maybe hundreds of years. Well, over that hundreds of years cycle, we can say on data that on average property prices across the UK double every 10 years. There's some kind of a argument to that, whether how accurate that is, but it's kind of 80% accurate. Property prices do go up over time. If you watch my video on the 5 best areas to invest in the UK, you would see that all of those areas have gone up in the last 10 years, close to double, okay? If not just under double, but they've all gone up by £100,000, £200,000 over a 10-year period. So we know as a matter of fact that on data, on science, on mathematics, that property prices over time in the right areas do appreciate. Okay, and that's one of the reasons why people get into property in the first place. One is cash flow, second is for capital appreciation, and that's how you build that long-term wealth. And that's honestly why 95% of millionaires come from property and have an average net worth of around £3 million over a prolonged period of time because of the capital growth. But when you get capital growth like that on a commodity, on an asset like property, if you buy in a normal limited company, you end up paying inheritance tax at 40%. So I see this all too often, and the solution to that is to set up a family investment company. There's many videos on my channel that talk about family investment companies and how to mitigate taxes when growing a property portfolio legally in the UK. But why is this such a problem? Just to kind of crystallize this point, when you buy properties in this way, either buying them in your personal name, an LLP, or a normal off-the-shelf limited company, it's kind of like setting up the foundations to your property business all wrong from the beginning. And the analogy I use is kind of like taking all of your hard-earned money and putting it into a bucket which has a hole in the bottom and it's all coming out. Like, you wouldn't carry on pouring water into a bucket that had a hole in the bottom, right? And most people do this. It's like trying to build a castle on sand. And as a result, if you try and compound and grow a property portfolio with the wrong tax structure in place, you end up just creating huge tax liabilities at scale. And honestly, you end up spending tens of thousands of pounds, hundreds of thousands of pounds, and in most instances, millions of pounds in lost taxes over the years. So that's the first biggest mistake that I see property investors make. The second mistake that I see property investors make is that they invest in the wrong area. They kind of have this limiting belief. They don't make decisions based on data. Too many people are making macro decisions when they invest in property. They don't have a financial plan. They don't know their numbers. They don't know the exact strategy based on the capital amount and the capital position. They don't know the exact strategy that they need to deploy to get to, say, 5,000 or 10,000 a month, right? And without knowing that exact strategy, it's impossible to select the right area if you're going to do this in the right way. And the mistake that they make is that they just basically go on word of mouth, basically where their friends are investing, of what's worked for them, without knowing that their friend's individual situation might be different to their own. Maybe their friend has a different capital amount to invest. Maybe their friend's got £1 million and is happy to take a 10% return. And maybe this individual's only got £50,000 and needs to get 20, 30, 40, 50% returns on investment. Well, those two types of people are obviously probably going to be A, using different strategies, and B, going to be using different areas for that based on their individual tailored personal situation. Now, the other problem is that most new property investors have a limiting belief about, I need to invest where I live because that's where I feel safe, and they have a fear of investing outside of area. Now, the problem is, if you're someone like me, this was exactly my problem. I lived in Oxford. I come from Oxford, and I was born and raised there for 32 years. I lived in Oxford, and the problem with Oxford is the yields are super low, like 3, 4, 5% max, and you just can't get a good return there. So you end up tying up all of your capital, and you can't actually truly scale the property business. So I actually had to invest outside of area, and I invest in the greater Manchester area around Stockport, Wigan, Manchester, all of those sorts of places, and into Liverpool, etc. And in 2025, my investment area that I'm going to be focusing on very heavily is Leeds. Now, the way that we kind of fix this problem is we have something called the Rightmove matrix, where we basically go over to Rightmove and we pull in all the data from Rightmove into our spreadsheets with all the analytics, and we work out the exact average house price, exact rental income for any given specific property strategy, and we make sure that the numbers work first, and we reverse engineer that. So if we want to get 25% return on investment using an HMO strategy, we need to know that average house price is X, average rent is Y, and average asking price that we can purchase that property for in that area, listings on Rightmove, is Z, right? As an example. So you've got to break that down and know that. And if you don't know that, you just end up wasting hours of your time trying to invest in an area where the numbers just don't work. And you're truly constrained by your own limiting beliefs, which is, I can only invest where I live. Now, again, just to put this into perspective, when you're a business owner and you think of property like a business, and this is how I want you to think, and you understand standard operating procedures, actually, you must understand that you're a property investor, and you only have 2 jobs as a property investor, okay? You need to run it like a business, like a CEO, okay? And the 2 jobs that you have are finding deals and raising money. If you get good at both of those things, everything else should be boiled down into delegation, okay? So for me, for example, I live in Dubai right now. but I still invest in the UK, which is circa 3,500 to 4,000 miles away from where I live. Yet I have individuals from the UK that are scared about investing half an hour away from where they live because they think it's too far. So there's kind of like a different kind of mindset shift that needs to happen, but it comes down to they don't understand their strategy. This is going to be the best strategy for them. They kind of get lost in shiny object syndrome. They see people making £1,000 from HMOs, or they see people making £1,500, £2,000 a month from service accommodation net. They see their friend did a commercial to residential development. They see lots of people online talking about lots of different strategies, and they basically try and execute all of them, and they end up basically achieving nothing, right? And when they don't know the strategy, it's impossible. If you don't know the exact strategy for you that's going to get you to your end goal, how are you possibly going to know what's the right area to invest in? That's the biggest mistake I see people make as well. So you must make this like a systemized process where you can granularly have a set of defined parameters for you to know this is the strategy that I'm going to deploy to get to X pounds a month of income, starting with X amount of capital. And based on those three variables that are predetermined outcomes, we're going to invest in this area because we know that this area has the best tenant demand, the numbers work, we can get 20 to 25% return, even close to asking price, and the numbers just work. Especially if we're doing a buy, refurbish, refinance model, we need to run the numbers on exit. And people just don't understand this stuff at the granular level. They have no systems to track this, and they're not making decisions at the micro level based on data, and they're truly guessing. Okay, and it's kind of like when I say to people, I ask people, okay, like for example, we had a client the other day come in, they said they're from London, and it's like, okay, wait, do you know like what's the best area to invest in? Like, have you determined that? And it's a bit like, well, I think Doncaster. Okay, like why Doncaster? My friend invests there. Like, it's honestly as like generalist as that. Or it might be like, oh, there's good infrastructure there, good transport links, fine. Better argument, but they still don't know the granular numbers, the granular data, the granular metrics, and they haven't reverse engineered that into a system that's tailor-made for them to know that they can find deals in that area where the numbers are just gonna work. So they fall at the first hurdle, they try to find deals, and they realize, hang on a minute, I wanna get 20% return on investment, but actually I haven't actually ran the data to know if I can actually achieve 20% in this area. Okay, so take the example of, say, someone who lives in London or Oxford. Well, you're just definitely not going to get 20% return on your investment, right? And most people starting out with less than 100k of capital, like just period, like conviction, like just don't even try and make it work in Oxford or London. It's just not going to happen. So you're going to need to go further afield. And people kind of have these limiting beliefs around that. So that's a second problem and the second biggest mistake that I see property investors make when they're trying to start a new property investment business. The third mistake that I see people make is that they don't have a lead generation system in place, okay? So they don't have a proven lead generation system to buy properties off market and to buy them at a discounted price. One of the secret ingredients to becoming a successful property investor and building out a successful property portfolio is that you need to be able to find deals at a discounted price. Now, that's easier said than done. And again, they don't know the math. How many offers do I need to put in order to get like 1, 2, 3 deals accepted under market value? And let's say that the target market value for the purpose of this video hypothetically is we want to buy 25% below market value. Well, in order to buy 25% below market value, like we can't just go to Rightmove and then deduct 20% off the asking price or 25% of the asking price, because you're just going to end up with a flurry of offers being rejected. You feel like property doesn't work because all you hear is no, 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 no. You start to become despondent, you start to feel frustrated, and again, like I said, you probably end up just giving up and thinking that you can just never get a deal below market value, which couldn't be further from the truth. The fact is, you just don't have a property follow-up pipeline in place. Like, you're not building your pipeline, right? And what's lacking is you lack a lead generation system. So once you know your area and you can get laser focused on, this is the strategy I want to deploy in this area, with the first principle in place in the right tax structure, we can now send the right lead generation strategy to target the exact areas that are going to be best for your strategy, your area, and then select the right property. So this probably all makes logical sense as I explain this in this video, but believe me, logic and human behavior don't go together. And again, I'm just being completely frank and open with what I see, having coached over 1,000 clients since 2018, right? I see these things happen. I see people making these mistakes, and daily within our mentorship programs, we're correcting people on these mistakes and providing them with the lead generation systems to get laser focused in the way that I've just explained to you. So you must have that lead generation system in place where you can acquire properties under the market value, and that there's enough stock availability in that given area as well. Right? Because typically speaking, we see like 1 in 40 properties get accepted at 25% below market value. And we know that 3 out of 4 property deals fall through. So if we know that to be true on data, then we need a follow-up system in place. And we need to be following deals for like up to 6 months at a time, sometimes 12 months at a time. But if you don't have that follow-up system in place, then that's where you're missing out on your deals. And it's kind of like, again, you've got kind of like a bucket in the system, there's leaks. Okay, and to tighten up those leaks, you need to put the follow-up system in place. So you might need like a custom CRM, like a client relationship management system. Okay, so it's kind of like the analogy I use would be like, well, if you're going to start a sales business and you're selling, well, most people don't buy on the first call, right? Sometimes you have a 2-call process, sometimes you have a 3-call process, and in some businesses they have like a 6-month process. I know when I was doing medical devices, for example, to bring on a new account, average sales cycle is like 12 months. So if I don't have a follow-up system in place, then I'm never going to be a good account manager. I would have never have sold any spinal prosthesis projects to spinal surgeons, because I know that my purchase window, click to purchase window, the day that I meet the surgeon to the day that he accepts the first surgery on average is 12 months to get into a new account, right? In other businesses, it will be different, like make money online space. Like some people have a purchase to click window of like 7 days. Some people will buy on the first call, some people buy on the second call, maybe 7 to 10 day follow-up. But if you don't have a follow-up system in place, then how are you going to grow your property business? And again, these things sound intuitive, but they're more business principles and business fundamentals. And a lot of people, when starting a property business, lack the business acumen, and they don't treat it like a property business. Okay, so they don't have any of these systems in place. They're lacking the lead generation systems, they're lacking the area analysis systems, and they're spending hours of their time trying to do things manually. It's laborious, it takes a long time, the data's wrong, they're tracking the wrong variables, and it all ends up in a bit of a mess. And again, they're paying too much taxes. So again, these are like the top three biggest mistakes that people make. Okay, so the fourth biggest mistake that new property investors make when starting to grow their property business is they don't know how to recycle their money. Okay, they don't know how to buy, refurbish, refinance, and recycle. They're using the wrong strategy, and I mean the wrong strategy from a financial perspective. They basically tie up too much capital in their first few deals. So they might buy properties in the traditional way, which is I'm going to buy a property, I'm going to put down a 25% deposit, take out a 75% mortgage, and I'm just going to let it cash flow. And hopefully the property, and the key word there is hope, that over time this property will grow in appreciation. And what limits them is not only this strategy of just putting down a 25% deposit because they're scared of maybe adding value to a property, they've never done a refurb or renovation before, they're worried about managing a builder's team or having to do the works themselves. Again, these are all just classic mindset issues that people have when starting out who are brand new to building a property investment portfolio. Secondly, to not understanding that, okay, well, just the traditional strategies means I'm going to run out of money and I'm not going to be able to scale very far, so I'm never going to get to my end goal. It's kind of like putting a glass ceiling on the business from day one. The second thing is that they're unsure of the exact creative financing strategies to grow the business, so they actually end up limiting their property investment portfolio based on the capital that they have. So let me give you an example. So we see clients come in typically with 50 to 100K as kind of like average starting point in our front end offer, where people are starting from like complete scratch, like 50 to 100K cash or usable equity. They kind of limit themselves on, I've only got 50K of cash to do my first deal or first 2 deals, and they're not sure about how to use creative financing strategies to grow the property business, and they get scared by the terms other people's money. And I totally understand why. But again, once you understand that actually other people's monies includes like good leverage, leveraging the bank's money, using private investors, private equity, raising capital from high net worth individuals that are cash rich but time poor, you can create this ethical win-win when you know how to build the safety, the margins, the knowledge. And the key is the knowledge. Once you have the knowledge, what happens is all of your fears or concerns about growing a property portfolio and using other people's money to grow your property portfolio tends to diminish over time. But it starts with learning the knowledge and you actually going through and doing your first deal and seeing the process work. And that's where you need to use sort of like a buy, refurbish, refinance model or a fix and flip model where you can regenerate the capital. But all too often I see people come in, start their property portfolio from a limited belief that I've got this set of capital, 50, 100K, that's all I've got. How far can it go, right? And they just end up tying up too much capital in their first few deals. And the reason they tie up too much capital in their first few deals, and the reason that I'm telling you the classic mistakes that people make in this chronological order, is because it starts with the tax structure being wrong in the first place, so they give away too much taxes. It then starts with them selecting the wrong strategy for the capital amount that they've got to start with for the desired cash flow outcome that they want. And it then starts with them selecting the wrong area where the numbers just don't work, where they can't get the ROIs and pull out the cash and recycle the cash at a high enough return, like 20, 30, 40, 50, maybe even 100, infinite return on your money where you pull out all the money so you can recycle that cash to go again. They don't have that area in place. They waste hours of time there. They don't have a lead generation system to be able to buy those below market value properties, to then add the value, to then create a big enough gap, if you like, between what they bought the property for and what they can refinance it for to pull most of that capital out. And again, this all results into why they leave too much capital in the first few deals, alongside, simultaneously, in parallel with the other points that I've just made about the traditional strategy of just putting down a 25% deposit or buying off-plan investments because maybe they think they're too busy to run a BRR strategy. But it's not actually time that is required to run a BRR strategy, because if you set up the business in the right way and you have builders contracts, you delegate, you have people finding deals for you, you have a lead generation system in place, then actually you can limit your time to the same amount of time that it would take you just to go and find a deal and put down 25% deposit. They actually just truly just don't understand that just yet. Okay, so that's like the fourth mistake I see people make. Now, the biggest mistake that I see property investors make all of the time when starting out and growing a property portfolio, probably the most fundamental one, is they only have one exit strategy per deal. What do I mean by that? So they start off and they look at a deal, and let's say it's a buy-to-let, just to keep things simple for now. They say, okay, I'm going to do a buy-to-let strategy and I'm going to rent it out to the professional market. And for whatever reason, they choose the wrong area and they can't tenant the property, okay? And then they haven't understood that, well, if I can't get the property tenanted, what do? They've just got that one exit strategy. They put all their eggs in one basket, just relying on finding a professional tenant, and for whatever reason that falls over. But what about if they thought about things in a more perspicacous and in a more shrewd way, and they were able to say, well, okay, if I've got product market fit in place anyway and they follow first principles, this wouldn't happen. But for the purpose of this video, they say, okay, well, if I can't rent it out to the professional market, what about a second exit strategy, which would be, what other demographic of tenant could I rent it out to? Could I rent it out to students? What would the numbers be on that? Could I rent it out to, say, a social housing provider, such as a Serco, a Mia's, or a Ready Home, depending on the location of where it is in the area? That could be like the third strategy. And the fourth thing is like, well, if I end up buying this property, adding the value, and for whatever reason not being able to rent it out in the way that I want to rent it out because the numbers don't work or I've made a mistake, can I sell this on for a profit if I fix and flip it? So there's like 4 exit strategies on the same deal, like just straight away. There's more exit strategies that you can do, by the way, but without making this video too long and getting into the granular and going too micro, I just kind of want to make the point that people only have one exit strategy. So classic example that we come across is this one. So I've seen this happen recently within the program. Someone came, they wanted to do a HMO strategy, and they were looking in areas where they were going to basically give the property to Serco, and that was their only exit strategy. I'm going to buy a property, do it as an HMO, and I'm going to give it off to Serco. I'm going to get Serco to take it off from me. But 2 examples. The first example is that, well, Serco have procurement areas, and for whatever reason, Serco started to pull the procurement area where this individual, pull properties from the procurement area where this individual had done his area analysis. And then they kind of got a bit flustered and was like, well, what do I do now? And it's like, well, did you follow first principles? Did you not just rely on Serco? What other exit strategies could you use in that area, in that example? If Serco don't want to take it anymore, would the professional market work? Could you rent it out to students? Could you do 4 co-living and put 4 en-suites with kitchenettes in? Get a commercial valuation. Do the numbers work if Serco don't take it off you, where you could sell it on for profit? Have you thought about what other social housing providers are in place? Or could you do a rent-to-rent agreement with somebody else? There are other like construction companies or Amazon distribution centers where they need to house workers, or hospitals, for example. Like, they just weren't thinking like this. They only had that one exit strategy. Now, recently, again, just being really shrewd about this and frank and open, we have people that work for me within the business propertyconsulting.io, and they were recently doing a 20-bed HMO, and because they're a good property investor and they don't make this mistake, they were turning a property into 20 rooms. It already had pre-approval from Serco, and they were on site refurbishing it to Serco spec. It had already been pre-approved, contract already agreed and signed, and then 3 weeks before handover, Serco pulled the contract. Well, if this individual didn't have a second or tertiary exit strategy lined up, this individual would have been stuck and be having problems. But because this individual obviously works with me, has been in property a long time, understands the game that he's playing, is a very shrewd investor, he already had second and third exit strategies lined up, and in the end he ended up giving it to another social housing provider in the area that took it off him and signed the contract straight away. So again, it's about having multiple exit strategies and not just relying on one exit strategy if you want to be a good investor and be really successful about growing a property business. So hopefully that makes sense. The 5 biggest mistakes that I see new property investors making when they start. Don't be one of the people that make those mistakes. If you want to get involved, if you want to learn more about these mistakes that people make, if you want to understand how to implement the lead generation systems, the strategy and the area analysis systems, we've already done all of that hard work for you. We've built out the whole model, the whole framework. It will save you a ton of time. Click the link below, book a call in with my team, and if you want to work with us, then feel free, and we'll see if we can help you grow and scale your property portfolio without making any of these costly mistakes.